All right, all right. There was already a little bit touching upon questioning about the fund of funds, but now we will discuss. First, I'd like to welcome Dominic Meyer, partner at AXA Venture Partners, mainly focusing on the fund investment, but of course you guys do also direct, right?
Okay, great. Thank you for having me. Great to be here. Excited to talk about the current fireside chat. Thanks. Oh, there we go. Now it's on.
Now it's on. Yes, yes. Super. Yeah. Okay. So, well, first I was wondering, have you in Helsinki? Have you been here many times before? And maybe I want to know, do you have any portfolio in the Nordics?
Sure. I have been here before, not during this time of year. So it's quite strange waking up at 2 a.m. and it being day. So that's quite nice. And we do have a portfolio in the Nordics. We have one fund commitment that's here. But through our other funds, we have exposure to other Nordic companies at the later stages. So yes, we have exposure here.
Okay. And is there appetite for more?
Yes, there always is. We are an investor that looks at manager selection from a bottom-up perspective. So we don't have a top-down allocation to say we need 6.2% in the Nordics. We're at 6.1. We have to find someone new. We try to make sure that we look at managers. If they meet our bar, then we will add them.
Okay, then you can a little bit also, well, I will touch upon that, what you do, fund investing. Can you open up a little bit on the exact role and what's on your day-to-day kind of like a drill look like?
Yeah, sure. So we allocate capital into venture on behalf of LPs. A large LP in our funds is AXA. There are others too. We have a global investment purview, so we look to allocate capital across established venture ecosystems globally. The majority of that capital is in the US, just by the size of the market, followed by Europe, and then the rest of the world where we make the determination that it is an established ecosystem, we commit capital there too. The vast majority of my day can be described as kissing a lot of frogs and hoping that some turn into princes, and I get to find out 10 years later.
Yes.
So.
All right, I may ask more about that kissing part later, but let's go to the risk and the returns part. So let's separate them for a moment. How would you describe risk in directs versus fund of funds?
I think at the very, very highest level, investing into funds, you're taking a manager selection risk, which comes with all of the different issues that it comes with, especially in venture, which is a very unique asset class. And when we think about risk from a fund-to-fund perspective, it's more of an asset class risk, i.e. making the determination that venture will perform over the next decade plus. And the necessity with regards to how to judge that risk in each asset class or each type of investing is, do you believe that the fund-to-fund manager you choose will deliver attractive performance, top quartile plus? And the manager selection piece, if you're going directly into funds, is much more complicated. There's more nuance there.
Yeah, for sure. And then, of course, there's also the combination of co-investing with the GPs you invest in. So how popular is this model? How do you say?
Yeah, so I think that's the other piece. So, you ask 10 LPs a question and you'll get 10 different answers. There's no consistency across strategic asset allocation, reasons for doing things, investment process, and everything. And one of those things then comes back to, why do you invest with GPs? And it was mentioned in the previous panel as it's an avenue to be able to co-invest alongside those GPs, maybe even lead subsequent rounds and build closer relationships with the underlying founders. And so one of the things that, again, I think makes venture capital very unique, and it was alluded to with the last question in the previous panel, which is great, is that it is a people business and it necessitates proximity, either to your managers, to the geography you're investing in, or to the underlying founders. And therefore, being able to form a view on that risk through proximity is really important. But also having the foresight to understand when to delegate the authority to make those investments where that proximity does not exist, right? So that's kind of, perhaps looking at doing direct investing in Finland, but maybe delegating that to a fund of funds outside of your immediate geography of focus, where that manager selection can be delegated.
And then you get to kind of piggyback the best portfolio companies there.
Exactly. And I think, if I were to, at the, again, very highest level, describe venture, I would say it's an access class, not an asset class. Access provides you with returns. It's been proven through decades that the performance is sticky in venture. And so I think getting that access is important, and that access requires constant proximity.
And of course, we have a bunch of allocators in the room, right? So how, as an allocator, should evaluate then these different asset classes based on their risk profiles? Of course, fund of fund versus direct is different risk profile, right?
Yeah, and I think, that comes down to what role do you expect venture to play in your portfolio? Do you want that to be one of exposure and therefore kind of tracking, let's say, an index-like return? Or do you want that to be one of alpha generation, which again predicates yourself on setting up a resource model which allows you to form the view as to where alpha will be generated, and then to devise a strategy with regards to how to access that, build allocation there in a way that is meaningful for your program, right?
Okay.
So it's hard.
Yeah, it's hard for sure. And then have you seen any, market movements or new ways of, evaluating or tolerating risk? Is there anything?
Yeah, I mean, with recency bias, I think one of the things that was mentioned in the keynote is that, venture has become too big, right? We can only look back to the excesses of 2021 with regards to investment pace, dollars invested, and the current, watermarks and where they sit very low in terms of performance. And so I think what we try to focus on and where we believe there will continue to always be some level of alpha generation is at the earlier stages, right? And to me, early is anything below or before a Series B, rather.
Yep.
And I think there you always have, to the extent it's appropriately executed, that strategy should give you an asymmetric return profile. You can only lose 1x, but you can gain many more than 1x. And therefore, it should allow you to through the cycle, deliver outperformance, and also, very importantly, uncorrelated performance to other asset classes through your allocation to venture.
Okay, I think that's enough about the risk, and let's go to the most favorite thing of every investor, the returns, right? We are looking for returns. So how would you categorize the returns in these asset classes?
Yeah, I think the attractiveness of the returns here is the upside potential, as I mentioned. 1x loss, but many x gain. And I think the other piece that's critical within venture is to understand where you believe you have a differentiated point of view and a point of view that allows you to have information asymmetry. It is through that information asymmetry, through the data you may have as an LP, through the relationships you may have as an LP, through the broader networks you have, to be able to form your own independent view and drive decisions through conviction around where to allocate capital to drive quote-unquote alpha.
And then, of course, for doing due diligence of you need different expertise, right?
Yeah, and that's coming back to my proximity point, right? Forming this view is fine. And within public markets, if you're a hedge fund, you can do this through publicly available information, build a thesis, pair some stocks, and create alpha. There is no database for venture. There's PitchBook, but it's very bad. So I think you need to have, feet on the street. You need to have networks, you need to activate them. You need to constantly be on the ground to understand what's happening. to be able to validate your own internal thesis and then translate that thesis into access and allocation to then be able to drive that outperformance if that is what you seek from your portfolio.
All right, everybody got their returns coming in. I hear the cash register clinging in about 10 years plus, right?
10 years at least.
Yes, yes. Okay, and then let's move to when you're doing fund investments, and of course then the manager selection is quite critical thing of that, right? Very focusing. What's your process? How do you do that?
So, this is much more art than science. And I think I joke that, the work you do with regards to selecting a manager is done when you are not doing diligence. It is when you're talking about other managers and soliciting background referencing on the manager you're not looking at. It is about being in the ecosystems where they're active and hearing the sentiment from participants. That could be founders, other GPs, other LPs. So constantly keeping a finger on the pulse of, who are the GPs, individuals that are preferred partners at a certain stage, in a certain geography, perhaps in a certain sector.
Amazing.
So once you develop this thesis through a long period of time, you then start looking at doing detailed diligence. And there it's a mix and an art of, track record, strategy, and team, where what we look at beyond all of this, or across all of this rather, is consistency. Consistency of track record, consistency of application of strategy, and consistency of team.
And how about the access part? How do you measure the access of a manager, for example? What's the good measurement on that?
Yeah, I mean, regardless of where you choose to spend your time as an LP, the key thing is to try to get there early. Because at one stage, you'll be there too late, the fund will be oversubscribed, and you won't get the access you need to drive the returns for your own portfolio. And so that's from the LP perspective. The GPs and the access they have to companies, again, it comes through soft referencing. You need to understand, are the logos on their website there because they have a 0.1% ownership and they're trying to buy logos? Or did they genuinely lead the seed round with a board seat, meaningful value add, and a real partner to those founders at the earliest stages? So again, it's having that cynicism in some ways to make sure that what you're being told is the actual truth.
And how about on more general on the strategy? How do you split for emerging managers and more established ones? And is the ticket sizes then what you're doing on the funds? Is it the same for emerging and established, or is there a difference there? What's your strategy on that?
Yeah, so I think it is very difficult to ignore as an allocator the multi-stage brands, platforms, and franchises in a diversified portfolio. They take the most risk in each underlying investment, but as a portfolio, as a fund, just due to their sheer size, they have a banded return profile. So it's difficult to ignore because they could get into the seed round of an OpenAI, and even if they have a $5 billion fund, it will make a big difference to their returns. But the majority of the portfolio, in our opinion, should be to smaller, more nimble, more emerging managers. There was a statistic about fund size and returns, which we subscribe to. And you need to make sure that part of your portfolio, you're kissing a lot of frogs. You're understanding whether or not differentiation exists. And you're making sure that you're constructing a portfolio without any unintended consequences. And that unintended consequence, in my opinion, is either over or under diversification from a portfolio construction perspective. Okay.
I'm thinking diversification. What do you think? Well, we kind of referred on putting the eggs in the many baskets there as possible. And how about as even spreading geographically? What's your view today on the diversification of the portfolio?
Yeah. it's a good segue. I think I didn't give you my background, but at a predecessor firm of mine, not the one I'm in right now, one of the vintages of their fund of funds had 120 funds in it, right? I would argue that regardless of the asset class you're pursuing, that is over-diversification. And you're leading yourself into a realm of undifferentiated returns from the perspective of the asset class. And so you need to determine from a first principles basis within your own organization what that diversification should look like from a number of funds, ideally, and be very disciplined around the execution of that strategy with regards to the number of funds. So the nuance then comes, do you do that on a global basis, on a regional basis, on a sub-regional basis, single asset class, multi-asset class? That all genuinely depends on what the rest of that portfolio looks like for you as an asset allocator and how that links up to the role you want venture to play in that asset allocation strategy. So it's different for many LPs. We only invest in venture, and so there's no considerations of other asset classes. We invest globally because it's our view that venture is a global game and outcomes can come from anywhere. And we think that across 2.5, 3 years, investing into 10 funds per year is appropriate. Therefore, we have 25 to 35 funds per fund. We think that is in the middle of all of those things I mentioned.
Okay. And then in the coming couple of years, maybe longer, where do you see the profits coming?
AI?
AI? Ooh.
It's a really difficult question because I think we're in a time where not only are we macroeconomically in a very different environment compared to the last 15 years with rates actually existing, which means there is a cost of capital, which means that valuations are lower. But we're also in a time where it's a 15-year cycle generally about the re-platforming of venture capital, and it's now happening through the mass adoption of artificial intelligence. What's interesting is this is the first time re-platforming has happened where I think incumbents have a massive advantage given the fact that data is really valuable. And so to me, the most important determination as to whether or not returns will come from startups or how much will come from startups versus incumbents is whether the incumbents take 80% of the market cap of this next cycle or 99.5%. It is still very unclear what that will be. If it is 80%, 20% of value creation in the next cycle coming from startups is massive and will mean that there will be many, many LPs and GPs across the world very happy with the returns they're able to generate. To me, the most important thing here is shots on goal, either as a fund at the early stage, 30 companies, high ownership, or as an LP, 10 funds per year, geographically diversified, to be able to make sure that you are capturing, if not top quartile, top decile performance of the asset class over that next cycle. To me, then, everything else will be fine.
Okay, we're running out of time, actually a little bit over time, it's okay. But I have this one very fast, rapid question, then we may have time for one question from the audience. I love asking this from the investors who diversify. If you have to put all your eggs in one basket, everything in one basket, what it's going to be?
AI?
AI. All right, quickly, anybody have a quick question? Asseri?
First of all, can you hear me?
Yes.
Okay, great. Thank you so much for the really interesting part when investing in funds.
So I think as an LP, we've committed over $400 million over the last 7 years across 50 plus funds, right? You get a lot of data as an LP. All of that data sits in PDFs on your share drive that you never read, that are completely unstructured, and that no one looks at, ever. We've taken that and turned it upside down. Everything we receive, we structure. We have a data model. We look for data points. We put it into a SQL database manually. AI isn't there yet. And we build a business insights tool on top of it to be able to stay on top of that data. So I think the supposition there about being too far from data as an LP is wrong unless you are a passive LP, in which case you don't read the reports and you don't get the data. So we've built a data advantage, we think, and we have these insights, and that not only drives closer and deeper relationships with all of our GPs, because they realize we read what they send, but we also have genuine proprietary data around trends globally across deployment, across ownerships, across valuations, across revenue growth. And that becomes really powerful when you're talking about 2,000 companies today, 2,500 in 6 months, et cetera, et cetera. It just compounds.
All right. Thank you so much.
Thank you.
Thank you.